Hello. We're going to get started here in just a moment. I don't ever know if we click the go live button, but I don't think we go live right away. So I will just pause for a moment if you are seeing this. We're kind of working under the assumption we're not yet on the air, but we may be. So just give us a moment and we'll get started with our YouTube live session.
Yep, we're live.
We're live? Okay, great. Thank you everyone for joining us here on YouTube Live. This is the Retire with Style podcast special edition with myself and Alex and Bill Bengen, who was on the podcast this week and who's joining us now to answer your questions live with a live Q&A. Bill, thank you so much for joining us.
Wade, thank you for the invitation. It's fun being here.
Oh, and it's our pleasure to have you. And I see the picture of your book behind you there, and I have my own copy as well, A Richer Retirement, Supercharging the 4% Rule to Spend More and Enjoy More in Retirement. And we're going to focus on questions that do relate to the topic of the book, which is really about the whole safe withdrawal rate type of question. We did get some questions in advance, and a couple of those were on different types of topics, like building a time segmentation strategy with bond ladders, that sort of thing. We'll hold off on those types of questions today. We'll really want to focus in on questions related to total return style, safe withdrawal rate, spending from a retirement portfolio. In that regard, we do have 7 questions that came in advance, and we will monitor the live chat to get to your questions. It's a great opportunity to ask Bill anything on your mind, again, related to the safe withdrawal rate question. And Bill, let's go ahead and get started here with the first question. Based on our discussion in the podcast, someone wrote, if Bill sees inflation as a primary risk in retirement, would it be wise to allocate some of those intermediate term government bonds into TIPS instead, Treasury inflation protected securities?
And the answer is yes. I think it definitely makes sense. It probably makes sense to have them almost all the time as a permanent allocation in your portfolio. But particularly now with inflation being kind of dicey, I think they look particularly attractive.
Bill, you had said, just because I didn't fully, it's good to have them all the time as a what?
Permanent allocation.
Oh, permanent. Okay, gotcha.
Oh, yeah, that's right. I don't include it in my book because I haven't been able to develop a background, a story for the asset class going back 100 years. But in time, I think I'll be able to work into that.
Yeah, TIPS have only been around since 1997, and trying to estimate hypothetical TIPS before that requires some guesswork.
Yeah, I would think so.
Probably the issue. Well, great. So that I think you also addressed in your book and also on the podcast, that you look at these 7 asset classes, but that may not be the whole story. So if someone's thinking about TIPS,
yeah, that's right. I would think most people would have a lot more than 7 asset classes in a portfolio, including REITs and gold and commodities, maybe alternative investments, emerging market stocks, and so forth, all worth your attention. Improved diversification.
Great, thank you. So question number 2 that came in advance, is the 4% rule still a constant? I've seen it taken as low as 3% due to increasing life expectancies, or does it vary depending on market conditions, etc.?
Okay, it's really important to recognize at the outset that the 4% rule was never intended as an immutable rule, something that'll never change. It's not like E equals MC squared or Newton's laws of motions, which we expect will be around forever. The withdrawal rate, in fact, has been higher in the past, the safe withdrawal rate. It was determined currently by the 1968 retiree, 4.7%. is that number. But if you look at, if I was to do my research back in the 60s, I would have come out with a higher number because we hadn't got into that terrible period of the 60s and 70s yet. As far as low end 3%, I don't see anything in a historical record that I have that would have required a withdrawal rate that low, even as recently as, 2008 or something with that terrible bear market. And unless inflation takes off to the upside, I don't think we need to be concerned about going that low.
Okay, and maybe the corollary to that question, if someone was thinking about a 40-year baseline retirement instead of 30 years, I think getting at that idea of life expectancies, what kind of impact do you see with extending the life expectancy that way?
Yeah, absolutely. If your planning horizon expands, you have to take your withdrawal rate down with it.
but not to a significant degree. I think when we're talking about that type of length.
Yeah, no, it's very comforting that just the way the mathematics work out, that as you get to very, very long life expectancies or planning horizons, it stops dropping. It hits a floor and doesn't get much lower, the withdrawal rate. So if you want to live 200 years, here's more power to you.
Great. Next question that came in advance, and we'll monitor the live chat as well. Research on withdrawal rates seems to favor that the accounts are being utilized are qualified. I don't get it. If I'm trying to withdraw $40,000 before taxes, isn't it the same whether or not I'm withdrawing from a qualified or a non-qualified account? $40,000 before taxes is the same $40,000 regardless of account type. So why the disclaimer?
Yeah, that question is making a reference to some comments possibly by someone else, which I'm not familiar with. In my work, I agree with the questioner that taking money out of a 401k, no matter what its status, probably doesn't make any difference.
Yeah, maybe another comment to add to that as well is just with the taxable account, the question's right. If you take $40,000 out, at that point, it doesn't matter what type of account you're taking it out of. But getting to that point, with a taxable account, you do have the ongoing taxation on the returns, the interest, and qualified dividends. And so that eats away at the growth of the account over time. So that would be why the disclaimer is important.
I agree. I think probably the equalizer there is that the taxable account pays taxes as it goes for income, dividends, capital appreciation. But the IRA account does not. So if you look at net after taxes, including taxes on withdrawals from IRAs, probably the total net amount left over is about the same from both types of accounts.
Okay. Wait, I've just because something you said sparked a question for me, and we're starting to get questions live, so we'll go over it. But let me ask my question right now, because I'm curious what your thoughts are, Bill, in terms of you spoke about if you amplify the asset classes within your portfolio, obviously you can get more upside. Well, what would your response be to somebody that says, hey, look, I've got 3 stocks, small cap, 3 stocks, large cap, 3, more of a stock picking approach that's very concentrated in a few stocks, saying, hey, I'm going to take 4% of this, and this should be a good thing. What would be your comment on something like that?
Well, following a riskier investment strategy, which is completely contrary to the index passive approach that I use in my book. So it's really hard to assess. Depends upon whether they're the new Warren Buffett or
exactly
or pretender. If they're the new Warren Buffett, they can probably take out 26%. But for most people, picking individual stocks is difficult. Not that it can't be done, but it's challenging, and it's also risky.
Okay, so yeah, I was just curious. The person who's sitting on, let's say, 5, 6, 7 stocks, thinking, "Oh, I'm going to take 4% from here, and I should be golden based on this book that I just read."
Well, yeah, I just think that's a risky approach, particularly if you got the Mag 7 stocks.
I just wanted to hear it from your mouth, not mine. From that perspective. Wade, you want to go into some questions? We got Johnny D with one.
Yeah, I do see that. I was in the wrong chat before, so I do see the live questions coming in. So the first one from John, a small cap may not perform well in the future due to flight to venture capital, private equity, and need of profitability filter. Isn't the safe max up to 4.5% from adding small cap overstating the future safe max?
It's a fair question. Small caps are clearly in a period of transition. And yes, equity, private equity and venture capital is becoming more important, and they tend to drain off some of the best small companies before they get to the mutual fund world. However, I'm not willing to give up on those small caps yet. They've had cycles before where they've greatly underperformed large caps, as they have over the last decade or so, and then come back and had dramatically good performance. So I think the jury is out on that. I'm not changing my allocations yet. I suspect small caps are entitled to a nice run here.
Okay, great. And Tony asks, Bill, your original 4% rule gave retirees a simple benchmark, but your newer research suggests we may safely draw closer to 5%. If we're now in an era of higher inflation volatility and longer retirements, how would you redesign the first year withdrawal rule to reflect both longevity risk and personal inflation rates without overwhelming the average retiree with complexity?
Sure. The two most important factors in determining your number, your withdrawal rate, are the inflation rate for the first 10 years of retirement and also stock market valuation. The idea being that if the stock market is very expensive, we're probably not very far from a major stock bear market. Major stock bear market early in retirement is always associated with lower withdrawal rates. So that taking those two into account, if I was retiring today, I'd probably be looking at somewhere around 5.5% for 30 years from a tax-deferred account, which is a lot better than the 4.7%. But then again, we're not faced with the dire economic circumstances that were present 50, 60 years ago.
Okay, great. And maybe a follow-up question to that while we're still on the topic of inflation from A. Castles. With current inflation, you discussed a 5.5%, what you just said, as a reasonable withdrawal rate for starting retirement now. If inflation pops up like it did during COVID, how would you recommend adjusting?
If inflation does appear to be a problem, I recommend reacting immediately by cutting, at least temporarily, your expenses until the storm blows over. We had a storm like that 3 years ago, where it got up to 9%, but it blew over. So although it affected the portfolios, it was nowhere near as devastating as the decade of high inflation in the 1970s. So yeah, I think you need to react to inflation defensively almost immediately, but be prepared, to raise your withdrawals when the storm clears.
Okay.
And when you say react immediately, you're speaking not necessarily of the allocation. You're speaking more of the distribution amount. Or are you?
Yes, absolutely. Yes, absolutely correct. What you're taking from the portfolio does reduce stress on a portfolio.
Okay.
Take less for the time being if you can do so.
Okay, I think this next question is on the same theme as well, and it's actually from somebody who has clearly read your book, and so may require a little bit of background to explain to the audience what the question means before answering it. But Calawish is asking, how bad of a deviation does there have to be for the current withdrawal rate from the synthetic withdrawal rate to have to change course in the amount of your retirement withdrawals? And that is something covered extensively, what these mean in your book, but we didn't even broach that topic on the podcast. So if you could explain what's meant by current withdrawal rate and synthetic withdrawal rate, and then how do you think about when those differ from each other when you actually make the adjustment?
Yeah, that's a great question. Current withdrawal rate is just simply your current year's dollar withdrawals divided by the starting value of the portfolio of that year. In the first year, it's what we call safe max, the safe withdrawal rate. It's identical because the first year is the first year. After that, however, losing my train of thought here, second. With respect to inflation increasing, just remind me the
Just
question.
repeat the question, Wade.
It's the one about, so you talk about the synthetic withdrawal rate charts in your book that kind of give you a course of where you want to be around, but then the current withdrawal rate might deviate from that. And what kind of deviation would trigger you to make some change to the plan?
The synthetic withdrawal rate is an arbitrary hypothetical curve showing what the current withdrawal rate should be each year during retirement based upon a very simple average return and average CPI figure. And you can compare that against your actual current withdrawal rate. There will be deviations almost certainly because the synthetic curve does not experience bull markets nor does it experience bear markets. So that what you'll have to do is make a decision if the deviation is due largely to a bear market that you're experiencing. I wouldn't do anything. I'd wait maybe 4 or 5 years, and you'll probably see, as happened in the past, that your plan will get much closer to the benchmark over time because of the stock market recovery. If it's due to inflation, though, it's once again in a matter where I think you have to act and be prepared to cut back severely if it looks like there's going to be persistently high inflation.
Yeah, and that I think you have several case studies in the book about that, and yeah, I think that's really emphasizing maybe the point here of bear market deviations don't necessarily cause you concern, but it's if inflation ends up higher, that's where you really talk about potentially.
That's the greatest enemy. Yep.
Okay. Great. We do also have a question from Mr. Dennis. So if we review the plan on an annual basis, it would seem that the amount of the 4% withdrawal would vary widely depending on the market return. That seems contrary to the idea of the safe withdrawal rate. And I think there maybe he's thinking of 4% as in what you call the strategy rather than the inflation-adjusted spending COLA strategy. So
sure.
To be clear what that question is asking.
Think, if you start at a 4% level, let's say withdrawals, it will fluctuate considerably due to market conditions. Bear markets will drive it down, bull markets will drive it up. That's normal to be expected. And the important thing is compare it to your benchmark, what your expected return is. And if it's within a distance of that, or if you know there's a reason for it that's going to take care of itself over time, there's no need for any action.
I'm not 100% certain on that response to the question. It could be I'm misinterpreting then the question. And the way I'm reading the question, I think he's a little off, Wade, right? In terms of not you, but the question. I think the person asking the question is thinking 4% of the portfolio every year, as opposed to 4% in year one. That sets the nominal amount, and then you adjust for inflation going forward. Right, Wade? I think he's the person asking the question is going like that.
It's that general confusion. Sometimes people misinterpret what 4% means in the context of the 4%.
As I just did.
No, but you'd be surprised how often that happens. And that's why I want to kind of like level set. I want to level set with the person asking the question that if you're taking a percentage of the portfolio every year, then fine. What this person is saying makes sense. But in the nomenclature of retirement income planning, when you say the 4% rule, thanks to Bill, it's taken as for whatever percent the first year is. And $100, you're taking $4 year one, and then every year thereafter, it's adjusted for inflation, that $4. And that's why you're getting at markets recover, but inflation kind of is more nefarious over the long term, and that's the biggest killer, because then that's why you're increasing, let's say, in high inflation environment, your distribution.
Yeah.
Did I clear things up, Wade, there, or did I convolute it even more?
I think that's okay. Yeah. If you are taking 4% of what's left each year, you have volatile spending, and so you don't. That's not really a safe withdrawal rate question. But Bill, maybe you compare the two strategies in the book. What do you find generally about the COLA approach, where you increase spending each year for inflation, versus the fixed percentage approach, where you let spending fluctuate fully in response to market performance?
Yeah, and it doesn't generate as much income during retirement as the COLA scheme, the fixed percentage scheme. However, it has the virtue of you never run out of money.
But that's like, I got good news and bad news, Mrs. Lincoln.
You don't have to worry about. You may take a 30% cut in expenses one year, but what the heck? You never run out.
Yes, I think that answers the question, because that's just right. The fixed percentage strategy is not what we're talking about usually with safe withdrawal rates.
That's right.
Actually, the questions are flying in now, and I got to figure out where we were on the list here.
All right, I will
think
I'm looking for the word synthetic on this. Okay, the next question is it's from Castles again. Thank you for answering my earlier question about inflation. As a follow-up, by how much would you immediately cut the withdrawal rate if inflation pops up, like a few years ago?
That's really an interesting question, and a tough question too. It depends upon how much inflation increases. If inflation goes to 4%, it's a modest change. But if suddenly we're in 7 or 8% inflation, then you're going to have to look cutting back very substantially, maybe 20, 30%, to get your withdrawals in line with what's
But
coming.
but my quick answer to your response is, but isn't that why you looked at the historical record and just maintain it, because it's, this is what's worked historically, and so the idea is it should work going forward. How would you, why cut anything? Is just go with it, because that's what was studied to begin with, and it should work out at the end. I don't subscribe to that, or not subscribe to that. I'm just curious what your interpretation is to that.
I would agree if you use the 4.7 safe withdrawal rate, the universal safe max I call, which is the worst case for all investors over the last 100 years. But if you're taking out at a higher rate, let's say 5.5%,
okay,
it does not incorporate the prospect of a prolonged period of elevated inflation. So you need to make adjustments.
Okay.
Yeah, that's fair. Okay, and then this is a more in-depth question. Tony asks, so in a richer retirement, you emphasize the importance of customizing withdrawal strategies based on individual circumstances rather than relying solely on fixed rules. For someone like me, retiring in 2025 with a mix of Roth assets, HSAs, and taxable accounts, how would you suggest integrating tax efficiency and sequence of return risk into a dynamic withdrawal plan that still allows for confident spending early in retirement?
That'd be a very complex question to answer, and I'm not going to really attempt to do it. I suggest that individual facing that situation needs to consult with a professional financial advisor to get full analysis of their situation, and get proper guidance.
And this is a question then for both you and Wade, and it's when you're doing your research, because we get asked this a lot, and it's an important one about ordering taxes, ordering of the sequence and the taxes. And when you folks are developing your research, it seems you don't even, taxes are just, you just control for it by saying we're not looking for it because of the nuanced approach, because it's so nuanced per individual cases, right? Have you, Wade or Bill, do you folks think about it like that? Like, listen, it's too complicated. I'm not going to concern myself with the taxes or the different accounts, tax deferred or so forth, because it's just impossible to satisfy everyone.
Well, can I answer? In my book, I analyze taxable accounts and the effect on withdrawal rate of increasing your tax rates. The higher the tax rate, the lower your withdrawal rate. Different correlation there, and that can be figured out mathematically without too much difficulty. Well, okay. I don't know if that responds to the question, but
yeah. Just how you view somebody consider taxes when they're looking at this type of research, since the research usually doesn't account for taxes.
No.
Yeah, that's just with a Roth account, there are no taxes. With the IRA, you pay taxes out of the percentage distribution rule. We talked about earlier. With the taxable account, it's not the same story because taxes are eating away at the growth of the account over time. You need to account for that.
Okay.
Yeah, okay, great. Next question. And actually, this question comes up quite a bit, and it's related to the tax question too, in a way, and rebalancing. So when calculating a safe withdrawal rate, are the percentages pulled evenly from a 5-fund portfolio? That's with the 5 different stock asset classes in the baseline portfolio. So are you pulling evenly from each of the 5 stock funds? I've always wondered, because obviously pulling from better performers and leaving a poor performer alone, I guess would work better.
Yeah, from my perspective, I use a total return approach. So I don't make distinction between whether income is generated from the portfolio from income, interest income, or dividend income, capital appreciation. It's all dollars, and they all mount up. And at the end of the year, there's a distribution made from the funds, and then that can be used in part to cover your withdrawals, which to a certain extent should be covered by your cash fund. That cash fund comes first.
But they're also getting at, if let's say you have 4 funds and one fund returned 100% for the year, sure, and the other 3 are flat.
Okay.
Does that factor into your decision making from a total return perspective? Or you just do it pro rata across the 4 funds?
Because rebalancing to a certain extent will take advantage of that phenomenon and give you an opportunity to earn returns from classes that have not performed well and are probably about ready to perform well. So I would make an adjustment based on that.
Yeah, for the listeners who do like to get into the weeds on that, in your new book, you're using quarterly data, and then you rebound the baseline, you rebalance annually. So if you're not rebalancing every quarter, how do you approach? Are you drawing equally from each, or do you, like with Alex said, drawing from the winner in that quarter with the 100% gain?
I'm not sure if there's a conflict there. I mean, rebalancing annually is just a process that you go through, regardless of what pattern you follow with respect to withdrawals. It doesn't matter whether you take monthly or quarterly or annual withdrawals.
Yeah, because if the one that goes up by 100%, when you rebalance, they're all going to have the same amount of money in them at the end of the day.
Yeah, after rebalancing.
Yeah, after
if you're not rebalancing every quarter, although I guess is the analysis being done quarterly or just annually, but starting from each quarter? Maybe this is.
I've tested it on. Yeah, I've tested in the book. I test on a quarterly basis, to see how that looks, comparing 1 quarter, rebalancing 2 quarter, 3 quarter, 4 quarter, and not rebalancing all. And it turns out that probably the best approach for retirees is to use the 1 year rebalancing. It doesn't deliver the highest withdrawal rate in all circumstances, but then again, you can't predict the circumstances and the withdrawal rates from that. So in the vast majority of circumstances, annual rebalancing seems to do the good job. Good enough.
And then when you do rebalance, it really didn't matter where you were drawing from specifically, because after rebalancing, you end up at the same point. Okay. The next question, if microcap's not available, what asset classes might you consider to replace microcaps in that 5 stock fund portfolio you look at?
Tough to replace a high returning asset class like that, earning about 11% plus over time. They might consider opportunistic investing, like emerging markets, which are very cheap now, are likely to have comparable returns, I think, over the next 5 to 10 years. You might want to consider gold too. I know it's done very well lately, the last 2 years, but the way our governments are spending, I think it's going to continue to do pretty well for a while.
Okay. All right. Next, Paul's asking, in your book in section 13.3, you mentioned risk management to protect against bear markets. And by that, it's not market timing, but you talk about strategically changing allocations. Okay, so what are your normal asset allocations, and how do you adjust your target percentages as a part of that risk management process?
Okay, what I'm recommending now is an upgrade from what I have in my book. I work a lot with a 55% stock portfolio. I've done some very recent research that indicates 65% works considerably better for the majority of retirees. So I would recommend a 65% stock, 30% bond, 5% cash portfolio. As far as adjusting that, the question is about adjusting that for what was the question? The question asked
for
about
the idea of risk management. You talk about in the book that maybe you'll deviate from the asset allocation target at some point.
Risk management, which also has another name called tactical asset allocation, is an attempt to preserve capital by reducing equity allocation or increasing it depending upon one's perception of risk in the stock market. And I use a third party to do that. I just don't feel comfortable doing it myself. I get my emotions involved. You have a third party that's done this for years and done it well. It's great to have that advice and not be worried, that you're going to do something damaging to your portfolio.
How big of swings, maybe that's really what the question's getting at. Like if that service suggests maybe now's the time to have a lower stock allocation, how far are you deviating from your target?
I follow their recommendations myself personally, but their recommendations recommend a range from being 100% invested down to 0%. They got you down to 0% stocks in early October 1987, before the big crash. So they rode through that crash without any ill effects at all. Okay, so you are willing to make big swings, it sounds like. Yeah, there are times where it could demand, and it's not just the reducing. It's very important. Like in April of 2009, it was very important at that scary time in the world to have a objective third party saying, hey, stocks are cheap, we got to load up now, get that allocation up there. It's very important. The most instinct of individuals, including myself, was, well, I want to see if the world survives this crisis or not. Of course it does. If it doesn't, we have such bad problems, whatever else we talk about won't matter. So I think it's best to take a view that the world will survive.
Okay. There is another question on inflation, and I think we've probably really already touched upon it, but to emphasize the point again, I'll ask the question. So if inflation is a big problem, why not take the entire bond allocation and put it in TIPS? Doesn't this solve at least part of the problem?
You could do that, but then you're taking a pretty strong position about what inflation is going to be doing in the future. And I myself have no clue. So I'd rather follow a more diversified approach and include assets that may not be optimal at a particular time, but over the long run have done well.
Okay, it's the entire bond allocation, not, I don't think you meant the entire, like, don't go 100% TIPS, just for the bond piece.
I would think that he meant, yeah.
Okay. Okay, some other questions on some tax planning things, but I think that's really beyond our scope for today. Okay, this is relevant. So with the US economy expected to grow at low single digits and international emerging markets growing at higher rates, what are your thoughts about the percent of equities to place in international or US? And just as a lead into that, in the book with your baseline allocation, you would have 20% international, 80% US because of the 5-way division.
I know that funds like from a major mutual fund supplier, which has a global fund, and invests 37%, I believe, of its assets in international stocks and 63% domestic. That to me seems like a reasonable breakout, particularly in view of the fact that domestic stocks are really expensive and international stocks are at least relatively cheaper. So increasing your international exposure here to me makes sense.
Okay, great. Next question. I found your inflation research fascinating. So continuing on that line, would not taking inflation adjustments in the first 5 years help mitigate the sequence of returns risks if starting at a higher than a safe max of 4.7%? So maybe mixing the level spending strategy with the COLA strategy and skip the COLA's cost of living adjustments in years 1 to 5. What do you think of that?
5.7%? Was that the rate they're taking out at? Or?
No. Yeah, it's just if you're starting higher than the universal safe max of 4.7%.
That's a tough one for me to comment on because I don't know what will happen to those factors, inflation and returns over the next 5 years. So once again, that's taking a position to a certain extent, which may not be justified by what actually happened. So you have to be careful of that. I mean, it sounds to make sense on the surface, but I don't know what it'll look like 5 years from now.
Okay.
Want me to answer the next one?
Yeah.
We have one here. Your approach to safe max is historical worst case. Morningstar models safe withdrawal rates using forward capital market assumptions. And Karsten Yeski's safe withdrawal rate series uses the worst of both of those. Thoughts on each approach?
Well, I have a lot of respect for the folks at Morningstar. They've produced quality research. Christine Benz is first-class researcher. I don't necessarily agree with their conclusions. Perhaps it's a difference in our methodology. I'm using historical data versus they're using projected data. The question is, how can we be sure about what will happen in the future? How dire will it be? I agree that over the next 10 years, American stocks are probably going to return a lot less than 10% a year, maybe zero. So that...
I mean, couldn't someone say, again, just to play devil's advocate, well, how accurate do you think the historical stock returns are going to mimic, future returns, or the future returns, better said, are going to mimic what happened historically. Wouldn't it be better to take the current valuations and assess from there in a similar manner
that's
that
what
you were
my
speaking earlier
methodology.
about tactical
Sure.
allocations?
That's my methodology does that basically. It introduces the Shiller tape and
Oh, okay.
measures stock market valuation. And that's one of the two prime factors that determine your withdrawal rate. So, I think you're right. It's covered by that.
Yeah, you're right. It is covered if you're getting to your initial number through that, yeah, then it would be covered. You're just not messing around with the allocation to cover. I get it.
And maybe also anyone using the forward projections, which I've done that sort of thing as well. But that was a bigger issue maybe 5 years ago when interest rates were incredibly low. And now that interest rates have normalized, I think if you ask the Morningstar team what their estimates were today, they wouldn't be talking about 3% numbers anymore. But okay, the next question on rebalancing. What about the idea of leaving rebalancing alone until equities hit 65%? And maybe that's merging, you talked about before. Your baseline strategy is 55% stocks, but maybe it'd be interesting to look at 65. What about, I guess, starting from 55, but not rebalancing until equities hit 65? I wonder how this would work, but rebalancing a taxable account generally does have a tax cost.
Well, the assumption there is that equity allocations will increase then over time. And then to extend something, they're proposing a variety of the rising equity glide path approach, which starts with a lower equity allocation and raises it during time. They're proposing something which basically it's not a conscious increase, something just rises out of market results, and that might work. I have, once again, I haven't run numbers on these things, so.
Yeah, some of these might just be more ideas of things to look at to see how that plays out.
Yeah, this field is full of surprises. I never make any assumptions about anything.
Okay, and well, right now we have a little pause in live questions. Please keep those coming in. We do still have some of the questions that came in advance, so I'll flip which list I'm using here for a minute. The next question, so why is the retirement planning community so hung up about the traditional drawdown paradigm in mapping out a successful retirement plan and not focusing in on the paradigm of a guaranteed or variable income model in which a lot of the uncertainty and volatility of the drawdown paradigm is reduced or erased? I'm seeing a trend in Generation Xers towards this type of planning. And maybe to just rephrase that in another way, it's kind of with what we talked about with retirement income styles, like why is there so much focus on just the investment portfolio? Is there, maybe the question for you, Bill, is like your thoughts on what about using annuities or bond ladders or other forms of protection as part of that distribution process as well?
From my perspective, I can answer that. Years ago, I defined my role as a researcher as trying to maximum the amount of withdrawals that can be taken safely from a retirement investment account without taking additional risk. So I didn't focus on anything else. But there's been plenty of work and papers published that indicate that having an annuity as part of your retirement income plan can be beneficial. And I know, Wade, you've done a lot of excellent work in this particular field. But I would give it serious consideration.
Okay, so yeah, it's not part of your research focus, but yeah, definitely you wouldn't dismiss it out of hand, it sounds like it. Okay, yeah, that helps. Another question. I believe Bill mentioned that the sequence of returns risk starts to reduce after the first 5 to 7 years. Does he think that this holds for, say, a 35-year retirement or a 40-year retirement? So maybe like the question's really, if the retirement length is longer, would you change that window where you have the most worry about sequence risk?
Yeah, I think the first 10 years of retirement are important to retirement, no matter what the length of the planning horizon, because what happens in that first 10 years will compound the longest to retirement. For example, if you have a bear market occurring in year 1, that's a serious problem. If you have one occurring in year 8, much less serious. So yeah, the sequence of returns risk does ameliorate over time. But you can't discount the possibility of something happening in the markets that's so outlandish that it might upset the apple cart. An example of that would be what happened in the late 60s when inflation started to rear up and lasted for over a decade. That was totally unexpected, I think, by most people. And who knows, we could have another financial crisis.
That sort of, since we're talking, that question was posed from the standpoint of market performance, and the fragile decade related to market performance of which you're taking a withdrawal rate. It would be interesting, and I'll pose that exact same question, but with inflation going out of control in the early years versus the later years. And I know the answer, but it's nice to hear it from you. Like, okay, consider the fragile decade, but replace stock market volatility with rampant inflation. How would they make would that affect, with the first 10 years of high inflation, proportionally affect more 40-year retirement versus a 30-year retirement, or vice versa, that kind of thing?
Absolutely. Yeah, because you're getting it right off the top. Your portfolio is taking a hit right off the top.
Okay. Another question that came in. So if someone was to retire today, does Bill still think the 4.7% universal safe max is appropriate given the high CAPE ratio, the cyclically adjusted price earnings?
Yeah, the 4.7% rule really doesn't take into consideration what market valuation is. It's a rule based on observation of one particular retiree out of 400 who in 1968 ran into a buzzsaw of back-to-back stock market declines and high inflation. So that I do think you need to take stock market valuation into account. I recommend in my book that a way to incorporate that. And today's environment, if you're looking at a 30-year withdrawal from a tax-deferred portfolio, I'd be looking closer to 5.5% rather than 4.7.
Because inflation is also not currently high.
Yeah, for the time being anyway, yeah.
Okay, and there's another question. It has come up somewhat already, so maybe there's not much more to add, but to revisit this point, Bill mentioned on the podcast that he's done some preliminary analysis on safe withdrawal rates with higher equity allocations. Can he discuss more of his initial findings?
Yeah, I've been experimenting with 65% versus a 55% in my book. And I've run a scenario on it, tested against all 400 retirees. And in about 20% of the cases, particularly for those retirees who had a major bear market early retirement, it doesn't work quite as well as a 55% allocation, but the differences are generally quite small. The reduction in safe withdrawal rate is small. For the other 80% of retirees, they get a pretty substantial bump in the withdrawal rate. So I think that it makes sense to use that 65% allocation and take defensive measures, risk management measures at times when the stock market looks risky. And then you'll have the best of both worlds.
Okay. Actually, questions are flying in now. I don't know if they're all, some of them may kind of be outside of the scope. Let me see if I can, some kind words coming in from Brett. So truly a great session. Thank you for putting this together. And thank you for your work and time and effort in publishing A Richer Retirement, as all of us walk the path. Nice. And here's another question. So I'm curious if Bill did any analysis on rising equity glide paths or I think now part 2, or otherwise using a longer time horizon, more around 40 to 45 years.
You're talking about rising equity glide path for the 40 to 45 year, or just two separate topics?
I interpret this as two separate topics. Now, the answer is yes for both. You have looked at both of those, so I don't know if, but yeah, maybe just a brief comment on the rising equity glide path idea, and then also the longer time horizon.
Yeah, it just so happens this morning I started work on a 40-year retirement scenario with a tax advantage account. And hopefully within a week to 10 days, I'll have that posted to my website. You can see the results of that. Obviously, the withdrawal rates are going to be lower. But I'm definitely taking a look. I'd like to build a library on my website of scenarios that folks can choose, like a buffet, something that fits their particular needs.
Yeah, please share what that website is, because I think that will interest a lot of our listeners. You do talk about it quite a bit in the book. You can't put everything in the book. So
No,
the
that's
website, you
for
have a
sure.
lot more
Not even
space.
close. Yeah. It's www.bengenfs.com. And the FS is my old business financial services reference. So it's good. Also, if for some reason we run out of time to answer all the questions, I also have a feature on that website where you can click on Ask Bill and ask me a question. I'll do my best to answer it.
Yeah, I think you'll get some good research ideas from our listeners that way as well. Okay. Just trying to see, there are a few questions. Here's from John. So Bill said that capital market assumptions are taken into account with his CAPE adjustments, but SafeMax still predicts along the lines of opposite of past performance does not guarantee future results. Maybe what this question is asking is just
that, aha.
Yeah, so the SafeMax as being based on historical data.
That's
We
correct.
always give the caveat: past performance does not ensure future outcomes. If you just want to comment on that concern.
Yeah, sure. Well, it's a legitimate concern. We, at our own risk, do we extrapolate past results into the future? Because we don't know if few conditions can be much different. Unfortunately, there is no methodology I know that can escape from that conundrum, because no one can really predict the future. So if we do use it, we use it with our eyes wide open, that circumstances may arise which may invalidate it and force it to a whole new approach.
Okay, yeah, and another question coming in now. So there's now a bunch of questions on the rising equity glide path.
Yeah.
So everyone, Bill does discuss that in Hereditary Retirement. So the first part of this question is just asking, have you looked at it? But I'll read the question. Recent research, including work by myself and Michael Kitze, suggests that a rising equity glide path in retirement may help mitigate sequence of returns risk. In your view, how compatible is this reverse glide path approach with the principles outlined in a richer retirement, especially for retirees who begin with a conservative allocation but want to safely increase their equity exposure?
Yeah, my conclusions I reached in my book, and I only analyzed one specific scenario. I think I started at something like 50 or 55% stocks and increased by 1% a year every year throughout retirement. And it did have a beneficial effect. It wasn't equally beneficial for all retirees. Some enjoyed more, some enjoyed less, but it worked, I believe, for just about every single retiree to start out with a lower equity allocation and let it increase over time. And I think you and Michael opined in your paper on that some years ago that it was the reason for that behavior is because you're avoiding the most serious effects of a major bear market early in retirement. If you have a very high allocation, you're going to get hit harder. If you start with a lower allocation, you have lower losses, and then you'll be increasing your allocation into a rising market, which is great.
Okay, yeah, and follow up on that. And yeah, I guess that's getting at this particular point. So right, in your book, you looked at the baseline 55% stocks. If you increase that to 85% stocks, your universal SafeMax actually increased to 4.8%. Right, and then the way we have looked at it in the article, and I think what these questions are also getting at is, what if you maybe went the other way? So instead of being 55% stocks throughout retirement, maybe kick down to, I don't want to go all the way to 25% for this scenario, but kick it down some and then work your way back up to 55% stocks. Have you also looked at that kind of direction for things, or might that be
that's essentially a rising equity glide path question, right? And I haven't looked. I've looked at allocations at 25%. If you keep them fixed, they're not good for your retirement withdrawal rate. But if you let it rise, it might work. I don't know. Once again, I need to run the numbers to have confidence in an answer about that question.
Okay, so yeah, that might be the future project is, instead of starting at 55 and going up from there, what about going less, but then working your way back up to 55?
It might work. I don't know until I actually run the numbers, and I plan to.
Okay. Do you see any other questions, Alex?
Well, but something I would ask, and we asked it in the podcast, but I'm curious now again, because all these questions about changing in allocations and all of that. And many times I'm kind of like, what's good enough, right? The greatest perfection is the enemy of good, that kind of quote. From an allocation perspective, I mean, is there a range that's fine and you know what, you can call it a day and not get all worked up about? Is there, like, could you say, listen, if you're between an allocation of, I'm making this up now, 45% and 65%, you're good to go, for the most part, and you shouldn't get too worked up about it or lose sleep over it. That should get you around there. Is there a kind of a range like that as well? Because I think people get caught up in this false sense of precision of 45% versus 43%.
Yeah, you don't want to cut it too fine. Once again, I'm recommending going higher to get a higher withdrawal rate without adding much risk at all. So, I'd be recommending a minimum of 65% in a retirement portfolio these days. Although,
minimum.
You may adjust that for tactical reasons right now.
You said minimum.
Yes, right. I'm going to study higher allocations.
Okay, so if anything, whatever equity glide path you choose, as long as if it was you, let's say if you started at 45%, whatever artificially low allocation you have, you'd want to end up at some point at 65%.
Or higher. Yeah, you might end up higher than that. Yeah.
Okay.
Okay. Another question that did come in, and I think it's back on this idea of like doing Monte Carlo simulations instead. So with historical data, we have a set number of observations. With Monte Carlo simulations, you could do 1 million test scenarios, and the worst case outcomes are always going to be worse if you start adding in lots of additional simulations. I guess the question's really getting at, like, what's your thoughts about making your numbers more in line with the worst case scenarios from a simulated approach, rather historical data versus Monte Carlo? Let's kind of put the question that way. What are your thoughts about Monte Carlo simulations in general?
If you're using Monte Carlo and you're using, historic returns as a base to generate expected returns for that, I think that's fine. That should agree closely with what I'm doing. But if you project returns for stocks, let's say, which are much, much less than would normally expect for an extended period of time, you may achieve a lower withdrawal rate, significantly lower withdrawal rate. And whether that is accurate, I don't know. I can't predict the future. Who knows what will happen? But
okay, fair enough. I don't see any other questions right now, Alex. I mean, there's others that may be outside of the scope of today. So we'll save for later.
I've got one for Bill. Bill, do you favor the Adidas tracksuit that you have on over a Nike tracksuit?
I check my endorsement contract first. No,
I'm more of a Puma guy myself.
This is one of my favorite. This is one of my favorite.
All right, looks awesome. I'm more of I got my pickleball paddle thing here, but I'm more of a Puma guy myself.
Yeah, when this wears out, I'm gonna be very sad.
Got to break out the cardigan soon for the winter.
Hey, you never know what comes next, right?
Maybe one more question, because I think it does. This question really gets at the heart of maybe some confusion about, in your new book, again, A Richer Retirement, Supercharging the 4% Rule. You're not really advocating for use of the so-called universal safe max of 4.7%. You're really talking about adjusting that based on the inflation environment as well as market valuations. That being said, let me just ask this question because it gives you a chance to really, I think, emphasize this point. So going back to the idea of adjusting the withdrawal rates when inflation is high or stock market performance is poor, it seems like that goes against the idea of basing one's withdrawal rate on the historical data, which suggests a 4.7% safe max. Your thoughts?
Well, I think we're talking about two different things. The 4.7% safe max is, once again, a worst case scenario. It represents an actual situation of a retiree who faced terrible bear market conditions, early retirement, terrible inflation. I don't see that happening in the near future. I think the stock market's going to be a difficult place, particularly the domestic stock market. But we may do well elsewhere. And over time, I think if you use, as I suggest, around a 5.5% rate, I think that incorporates enough bad news, otherwise you end up with too much money at the end of retirement, and the regrets people often have with that.
Great. So to wrap things up, Tony, I'll just read what Tony wrote because I think it's a great summary of things. Thank you, Bill, for taking the time to answer our questions with such clarity. Your insights truly elevate the retirement conversation.
Well, it's very nice.
Tony's going to replace us.
Thank all the listeners for asking some very sharp questions.
All right. Yeah. Thank you, everyone, for joining us and for asking the questions. And again, if you would like to learn more, read further, it's A Richer Retirement by Bill Bengen, the father of the 4% rule, really the father of present-day financial planning-based retirement income. And also your website, bengenfs.com, for those who like to really dive in even deeper than the book goes. All right. Thanks, everyone, for listening. Thank you, Bill. Thank you, Alex. And we'll catch you next time on Retire with Style.
Thanks so much, Wade, for having me.